Imagine Sara, an independent contractor in Halifax, Nova Scotia. She's been building a successful web design business, one client at a time. Things are good, but lately she's been thinking bigger. She sees an opportunity to expand, maybe hire a junior designer, and take on a few larger, more ambitious projects, the kind that could really put her business on the map. She's even found a fantastic co-working space downtown, complete with a shared meeting room and lightning-fast internet, that would cost her a tidy $1,200 a month to rent a dedicated desk. Sounds exciting, right? But here's the rub. Big opportunities often come with big decisions and big investments. Sara isn't just buying a new laptop, she's committing to a significant monthly overhead. This isn't a small choice. This could fundamentally change her business, for better or for worse. What happens if she makes the wrong call? What if that new desk and the junior designer don't generate enough new revenue? What if she's left paying $1,200 a month for a desk that sits empty, while her personal savings dwindle faster than a summer storm over the Atlantic? Her dream of expansion could quickly turn into a nightmare of mounting debt, sleepless nights, and the crushing weight of a business that's suddenly underwater. She could find herself back to square one, or worse, having to close her doors entirely. This isn't just about feeling like a good idea. This is about numbers. It's about understanding if an investment will actually pay off, and when. It's about knowing, with as much certainty as possible, whether a project will generate enough cash to justify its upfront costs and ongoing expenses. This is where proper business planning steps in, offering tools to peer into the future and make informed choices. Two of the most powerful tools in that kit are net present value, or NPV, and internal rate of return, IRR. Don't let the fancy names scare you. At their core, they're just different ways of answering the same fundamental question: is this investment worth it? Let's start with NPV. Think of every dollar you spend today, or every dollar you expect to receive in the future, as having a value. But here's the trick. A dollar today, a Canadian dollar in your hand right now, is worth more than that same dollar a year from now. Why? Inflation will erode its purchasing power. Opportunity cost means the money you have today could be invested and earning interest. So, a future dollar needs to be discounted back to what it's worth in today's terms. NPV does exactly that. It takes all the future cash flows, the money coming in, the money going out, and converts them into today's dollars. Then, it subtracts the initial cost of the investment. If the NPV is positive, it means that, after accounting for the time value of money, the project is expected to generate more value than it costs. It's a good sign. It suggests the investment will add real wealth to your business. If it's negative, the project is expected to lose value. It's a red flag, indicating the costs outweigh the future benefits, even when those benefits are brought back to today's terms. For Sara, expanding her business has an initial cost: setting up the new space, hiring the designer, training. Then, she has expected future cash flows, the increased revenue from new clients, minus the ongoing expenses like rent and salary. NPV would tell her if, when all those future dollars are brought back to today's value, the total is positive after subtracting her initial investment. Now, let's talk about IRR. If NPV tells you the net value of a project in today's dollars, IRR gives you the project's effective return rate. Imagine you invest $100 and it returns $110 in a year. That's a 10% return. IRR works similarly, but it's more complex because it deals with multiple cash flows over multiple years. It's the discount rate that makes the NPV of all cash flows from a particular project equal to zero. In simpler terms, it's the annual growth rate an investment is expected to generate. The higher the IRR, the more financially attractive the project. If Sara's projected expansion has an IRR of, say, 15%, and she knows she could otherwise invest her money in a relatively safe GIC earning 3%, then 15% looks pretty good. It's a benchmark. You usually compare the IRR to your company's required rate of return, or the cost of capital, or even just what you could get from a very safe alternative investment. If the IRR is higher than that benchmark, it's generally a green light, suggesting the investment is worthwhile and competitive with other opportunities. The real power of NPV and IRR comes when you have multiple investment opportunities. Maybe Sarah is also considering investing in a new high-end 3D rendering software that costs $5,000 but could open up a completely new revenue stream. Now she has two distinct paths, each with different upfront costs and different projected future cash flows. How does she compare them fairly? NPV and IRR allow her to do just that. They help her cut through the noise of raw revenue projections and ongoing costs to see which project truly offers the best financial return, not just in terms of total dollars, but in terms of the rate of return and the actual value generated in today's money. This isn't about gut feelings anymore. It's about a systematic, objective comparison. This is the surprising reframe. Financial planning isn't just about balancing your checkbook. It's about translating your vision into a series of calculated bets. It's about transforming an exciting idea into a quantifiable future, where you can assess risk and reward with clarity, long before you commit a single dollar. It's about giving yourself the power to say yes to the right opportunities and no to the ones that might look good on paper, but don't hold up under scrutiny. Without these tools, Sara would be making her expansion decision based on optimism alone, crossing her fingers and hoping for the best. With them, she can confidently project her future cash flows, understand the true value of her investment, and make a decision that protects her business and fuels its growth. Making these complex financial projections might sound intimidating, but it doesn't have to be. PMC Ava can simplify this process. Our new Venture Business Plan Builder helps you generate a full, grounded business plan, complete with detailed financials and all the necessary sections, for any new idea you're considering. It uses a deterministic, proven algorithm for financial modeling to ensure accuracy and avoid the pitfalls of AI hallucination. Take control of your business's future. Explore PMC Ava today.